Good afternoon, traders. This is Christian Fromhertz, Tribeca Trade Group, with your weekend video, getting ready for the next week. So we're going to go over a few different things here. We're going to talk about basically what happened in the market last week. We're going to take a look at some indicators. We're going to look at some things that maybe got to a little bit of an extreme level. We're going to talk about overall market sentiment. And then we're going to talk about some must-watch areas for next week, and I'm going to talk a little bit about single stocks as well. So, first chart, I'm going to talk about a few different charts that we're going to go through go through over this call. The first one is going to be why I'm going to spend so much time on more of a macro view is because you can see implied correlations really pick up. This is implied correlations of some of the names within the S&P 500. So all year long, this has been trending down. Implied correlations, basically how stocks are moving together, have gone down, down, down all year long, meaning stocks are not moving together. Hence, it's a stock. You hear people say it's a stock picker's market all the time. What does it mean? It means that stocks are not moving together. Some stocks are really outperforming. Some stocks are really underperforming. We've had this all year long. It's been in a stock picker's market. However, once volatility creeps up in the marketplace, all stocks start to move in unison. They start to move together. So this is what we started to see last year. You could see these big bars move up, and all stocks were kind of will either go down or go up together. So that's a little bit of what we're going to talk about. I don't think this is going to stay this way for a long time. I think we'll probably go back to a stock pickers market, but we're going to talk about the VIX as well, because that will bring. Let's bring up the VIX here. We did get a spike, obviously, which everybody kind of looking at. We did get to about over 16 and very quickly in the VIX. So I'm going to talk about whether or not people were adding money, betting on further volatility, or if they were taking profits. And I'm going to tell you where I'm going to derive that from. But first things first, let's go through I always like to go through every week in our newsletter, in the Tribeca Trade Group newsletter, what we know. And then we could talk about what things to watch for next week, but we could associate some probabilities. Not really make market predictions, but just kind of take a look at if things have gotten a little bit to an extreme, and if we could kind of associate a little bit of probabilities with what we think is going to happen next in the market. Of course, price is king, and that's really what we're going to watch. So we're going to check to see if we've broken down in any things, or if we're sitting on support, or if we've got more to go to the downside to hit support. So the VIX closing at 1553, off the highs. The S&P was only down 1.3% for the week. You would think that, for as much as the financial media kind of drones on about things, you would think that we would have had a 3 or 5% sell-off. Some things did, but the S&P, again, the S&P is market cap weighted. It's not equally weighted. But this stood up pretty well, only down 1.3% for the week. Small caps, on the other hand, have been going down for the last couple weeks. They fell 2.7% for the week. So they got their 3% move last week. Now, they've been down more than that for the last couple weeks, but they're now sitting at the 200-day moving average. And that's the first chart that I really want to take a look at. So if I go over to IWM, we can look at this in any particular chart. But you can see a difference. Actually, let's go ahead and we'll look at SPY first, because that's what people love to start with. SPY is basically at the 50-day moving average, right? So we've got some support there. It's not that big of a pullback. Every time that we have gotten to this 50-day moving average, the purple line, we've bounced pretty nicely. It's a little bit different when you look at IWM. Small caps are always a must watch for me, especially when there's a little bit of volatility, because sometimes what they'll do is they'll move first before large caps do. Sometimes they will provide a little bit of a signal, and they'll either start to make a move either to the upside or to the downside before large caps do, and before even mid caps do as well. So they did make that move first. This was Tuesday. Tuesday it was really, I would say, a pretty tough week last week, because remember, Tuesday a lot of things made 52-week highs. Small caps were not one of them. They did try to rally, and they failed pretty hard. But they were not even close to a 52-week high. So they broke down after Tuesday. They continued with this move that they saw a couple weeks back, and they continued to move down. So we're right at the 200-day moving average. This is very similar to a couple other things that I think you want to pay attention to next week, which is transports, which have also kind of been, got down to this below the 100-day moving average and into the 200-day moving average before some of the other sectors, and of course the S&P 500. So transport, small caps, very much to watch. I would say the DAX also. Globally, one of the things that's been really great all year long is that there's been a global rally. It hasn't just been the U.S. Even though, again, financial media will just focus on the U.S., there's been a lot of really exciting things going around the globe. However, the DAX has been giving signals for the last 2 months that something hasn't been right. It's been breaking down. Of course, with the euro getting stronger, that's part of the reason. But we're sitting right at the 200-day moving average. On Friday, the market action was not bad in the DAX. Started on the lows and finished basically close to flat, which I view that as a small win from Friday. But this is going to be pretty easy for next week when you've had things like the DAX, transports, small caps sitting on the 200-day moving average. It's a big decision that's going to be happening next week. Either these are going to bounce next week or they're going to fall, and that's not going to be a good sign for the overall market. So what else did we notice besides some of these areas around the globe breaking down? And I'm going to talk about a couple other ones too. But let's just change gears just for a second. I tend to look at the fear and greed index as a nice sentiment indicator. It really kind of just helps me and say, hey, when the thing is really greedy, coupled with weak seasonal time of the year, it really is not a place where I want to be adding to a lot of longs when this really starts to range. And it was just 1 week ago. It was at a 64. So it was running pretty hot. I think it was even got to a little bit higher than that. But where it is right now, we're right in fear territory. So this is more of a better place that I think to really put money to work. If you're going to be a little bit of a contrarian, I wouldn't say, some of the great investors, they always talk about when you want to buy when there's blood in the streets. I don't think there's blood in the streets, but I think, hey, we're definitely off of those exuberant levels that we were, a week or 2 weeks ago. So a 28 right now, again, this is a great, I think if you're interested in buying a dip, this is a dip. And I know that it gets very hard because people always say, oh, if I could always have a dip to buy, I would love to be putting money to work. Well, you got one now. So you have to make up your mind whether or not this is something that you want to buy or something that you want to wait for a little bit of confirmation. But you got a dip and you got a lot of fear in the market. What else? If we look at another indicator as well, if you look at the put call ratio, something that I look at quite frequently to see if, again, if sentiment is a little bit too high or too low. You could see a big spike up on Thursday and Friday. Actually on Thursday, this is delayed, I think, one day. Actually, it does give Friday's number, but so 0.94. So this is close to 1. It's pretty extreme for put call. You could see when you overlay this with an S&P chart, which is the orange line, the white line is the put call ratio. You can see that we got to a very extreme level towards the end of last week. What happened? So by overlaying this with the S&P, you can kind of see previous times when this has spiked up. You can see what happened briefly in April, and we ended up rallying from there. Even better, I would say, if you look at what happened the last time this spiked up, and this was right before the election, right? You could see this get to about the same thing. We bottomed a day or two later, and then what happened after the election, right? We rallied hard. If you go back and if you look for further events when the put call ratio has spiked up, this was back in June of 2016. The S&P also bottomed here. So it's not going to be no indicator is perfect every time. There's going to be a situation. I think when we really had a tough time in the beginning of 2016, you could see a couple times the put call ratio really got high. And we kind of put in that W bottom, but it was a little bit of pain for a little while. So again, not every indicator is going to work every time. It's just not how things work. But you could see a lot of times that we've spiked up like this, it's been a pretty good place to buy. So those are a couple things that I think are setting up pretty nicely. So let's just talk a little bit about the seasonality of the time. Now, I think a lot of people have, if you're a regular viewer of CNBC or Bloomberg, you've heard about people saying this over and over, right? This is not a great time of the year. August and September, it just is what it is. They're weaker times of the year. And sometimes these things become a self-fulfilling prophecy. When everybody talks about it, it starts to make people start to accept it. They could say, oh, you're right. I'm going to reduce my exposure. I'm going to buy some puts, and it becomes a spark, right? And we could have some selling pressure. So obviously North Korea was a big thing. The tensions with North Korea were a big thing last year. There was some comments made. Now that could also be a spark, but it is what it is. The market was pretty close to being priced to perfection with a VIX sub 10. Anything, right? At that point, when you're priced to perfection, anything negative, whether it be geopolitical, which I view as short-term buying opportunities for the most part, or if it's something else that's going on, that's going to bring you down. But basically, when you're priced to perfection, it just means just that. Anything negative that could come out, whether it's a couple of big investors kind of saying, "Hey, you should be buying puts." There's a couple of things that are really going to cause the market to shake. There's various different reasons, but the more people buy into that, and I think more people will buy into that when the market is priced per perfection, right? So it is what it is. It's a weak time of the year. So does it mean that we could bounce? So I think you want to just keep that in your mind that going back to the put call ratio, going back to the fear index, we could get a very nice bounce next week, but it could also be a bounce and then a lot of chop afterwards. So keep that in the back of your mind. So that's a couple things that I wanted to go through there. Looking at last week's performers, what did better I just want to spend a quick minute here. What did better? What things did better last week? It was basically your defensive. Gold miners did very well. Gold did well last week. Again, I don't think this should be really shocking to anybody. The banks did really bad last week. If you remember some of the economics that kind of got overshadowed last week, one of the reasons why we bounced a little bit on Friday was because the CPI was really low, which continues to say to the market that there's less inflation that's going on, and the Fed has less of a reason to raise interest rates. So that doesn't bode well for the banks. So the banks kind of took it on the chin pretty hard last week. The KBE was down 4.5%. If you remember, they rallied pretty hard after the jobs number. Well, they gave all that back. So retail was also down pretty big. Biotech, which also is one of the first things that usually gets hit when there's volatility, so that was down a lot, as well as energy names. In terms of international, this is where it gets a little bit more interesting. Some of the areas that really got overbought. So, for example, if you look at Hong Kong, the Hang Seng, this has been one of the best performers all year long, but look at how overbought. And I was tweeting this out several times last week, and I'm like, this thing is really running hot. So this was a need, I think, of a pullback. Look at the separation between the price above the 50-day moving average. It's just too extreme. So again, you talk about priced for perfection. The Hang Seng was kind of, to me, flashing a warning sign that, wow, we're running way too hot. So this did cool off pretty hard last week. Same thing with another area of the market, which is India. India just kind of came back to the 50-day moving average. We saw a lot of put buying, as this was pretty volatile and fell back some. So again, some of the best performing areas got hit pretty hard. And again, probably they should have, being this far extended, right? Grinding up every day, every day, every day. So this is one area that I'm looking at as possibly buying, as well as all emerging markets. You finally got a dip in this group, after it's run pretty nicely. So as long as I think it holds the 50-day moving average, I think it's a pretty easy trade. All right, so that's some of the performers. What did we see in terms of fund flows last week. So I always like to see, what occurred in terms of, did people really run for the hills and unwind some of their longs? Did they put a lot of safety trades on? What were they doing? So last week was almost a non-event in terms of ETFs. So equity ETFs, especially in the U.S., they did see outflows. 3.7 billion for the week is almost average. I don't think it's really heightened volatility. Of course, we did see a big move up in the VIX, so there was heightened volatility, but not in terms of money that was pulled out of the market. It was kind of just business as normal, business as usual. If you even combine, if you look at the names that had the biggest outflows, was your biggest ETFs. It's SPY, $1.7 billion, IWM, Qs. Those were the three top, and I think that's very predictable. When you have a lot of volatility, it's easy, very easy for people to unwind these because they're the most liquid things out there. So I don't think that there was a ton of other outflows. If we look at the sectors, yeah, the majority of sectors had outflows, even including utilities and REITs. But certainly there wasn't like a running for the exits. Just basically a little bit of money was taken out. Even industrials had inflows. Keep in mind, industrials is also defense stocks. There's defense stocks in the XLI. There's also ITA, which also gets grouped under industrials, how it gets classified by Bloomberg. I pulled this data from Bloomberg. So ITA is in there. So just be aware of that when you're looking at, why did industrials get so many inflows? It's because part of the reason is because there's a lot of defense names in the industrials, both in XLI and of course in the ITA. And then in international ETFs, it was definitely a little bit slower. Emerging markets and developed markets have been running at a clip of seeing about north of $800 million in inflows between one or another on a weekly basis since the beginning of 2017. So they definitely, developed markets still saw 616 million, which again is just a little bit off the weekly average. Emerging markets, they did not see, big inflows. That's also pretty decently below their run rate, but still nobody, they still saw inflows for the week. Japan, Europe did see some outflows. Germany, which we talked about the DAX, some money was leaving there. But again, we don't even see anything over $200 million in outflows. So really, really, nothing major to talk about. I'm missing the adjective that I'm thinking of, but very muted flows for the week. Now it gets a little bit more interesting when you start to think about and even in fixed income, there was some outflows to high yield bonds. I think that's pretty normal. $1.2 billion came out of the high yield bonds. They've been seeing a lot of inflows. So I think some of the weaker hands probably got flushed out, which we see this a lot in high yield bonds. For the overall week, if you look at all fixed income, it was basically flat. They had $200 million of inflows. Again, different flows within that group, like aggregate bonds, for example. Some shorter dated corporate bonds, those saw inflows. So it was really kind of mixed for the week for fixed income. But really where it gets more interesting, gold. Did people run into gold? No. GLD did not even see, no inflows last week for GLD. IAU, which is the sister fund of GLD, actually did see $76 million, but it's less than 1% of the fund. So again, very, very light. What about gold miners? Did they run into gold miners last week? Nope. They saw more outflows. So even though the technicals look pretty good to me in GDX, we're now above the 200-day moving average. The price action is just kind of sitting above here, but you could see this has not been an easy trade for the gold miners, and you could see all the outflows that GDX has had. If I can expand this a little bit. So even last week with volatility, there was one small inflow, it looks like on Friday, but over the last couple of months, look at all the money that's come out of gold miners. So it's almost to the point where this would kind of be a contrarian buy signal, considering all the money that's come out of GDX. But I'm personally waiting, and by the way, I already am long GDX. I got long GDX a couple weeks ago, as well as FXY, which is the yen ETF. Those are kind of my hedges that I put in place going into this weaker seasonality period. But I certainly didn't add to anything that would kind of set me up for a hedge. Those hedges have been in place. So I don't like to do knee-jerk reactions when we see a little bit of volatility. I don't buy puts as soon as we start to see the market go down. I like to do that a couple weeks in advance of either buying puts in SPY or hedging through other means, which I did with GDX and with the yen, going long the yen. So bottom line is we didn't see a huge amount of money going into there. And here's where it gets more interesting. What about the VIX? We saw just crazy amount of volume in all the VIX ETFs last week. So case in point, if you look at VXX, you could see the volume. I mean, these were by far and away the highest volume of any ETF last week was in the VXX. So VXX normally trades about 50 million shares average volume a day. It traded 250 million shares on Thursday. So what happened? Were people were going in, or was it just day trading, right? I mean, you're not going to see inflows if people are just day trading, right? Because they're going in one day and they're and in the beginning of the day, and then they're selling at the end of the day. So it's a net scratch, right? They're not really adding investment to it, and the funds don't create or redeem based on that. Same thing with UVXY, which is the levered ETF. I mean, this normally trades 6 million shares a day. That's the average 30-day volume. How many did it trade on Thursday? 70 million. So that's more than 10 times average volume that it saw on Thursday. So just crazy amount. So what did they do here? So this is, like I said, this is where it gets interesting. We'll look at VXX first because that's the big one, or that's the one that saw the most volume. Not much. So I actually have to draw in here and go to 6 month and just kind of so you could see how this works. But here's the big volume, the increase in volume, outflow. So it looks like there was a little bit of inflows in the beginning of the week, but there was an outflow on Friday. This gets even more dramatic when you look at UVXY. And take a look at this. So here's all the big volume. They took profits. It appears that they took profits. They did not double down. People did not go long UVXY. They said, hey, this thing has gone up from what? 36? Or where was this in the beginning of the week? 30? So $30 to 43. People took their profits. I mean, so this is evidence. I think I had this in here as, when I calculated this, it was $183 million of outflows. Again, so that is the levered VIX and short-term VIX instrument. If you go to SVXY, right? What is that SVXY? That is inverse VIX. So this does better when the VIX goes down. So what did they do to this one? I just messed this up. SVXY. Of course, that's not going to work. SVXY. All right, so you could see this. This was a big move down because this again is inverse to what the VIX is. So I don't have the fund flows on the bottom because I just messed up the charts, but I do have the raw numbers in here, and it was basically the direct opposite of what we saw for UVXY. They saw a sizable inflow on Friday. I actually have the chart down here. So you can see a huge inflow. So people are now expecting the VIX to go back down. So again, this is not my view. That's just what the evidence shows. The big inflows going into this as it went down, right? So they basically bought the dip in SVXY. All right, so that I think is probably the most interesting thing to come out of the fund flows for the week. And on the VIX side is that the people who were playing VIX took profits, who are expecting volatility to move up. Again, this is not options. This is just what happened in cash. It was I would say similar. We did see some call buying in VXX on Friday, but there was also I saw a lot of orders that went up on the bid side. So I think there was a lot of profit taking. Somebody who bought the January VXX, they could have also been rolling out. They could have also been selling front month premium. I don't really know. But just kind of giving you some of the fund flows for or what happened in the options world as well. All right, so must-watch charts. I think I talked about most of these. I talked about IWM. I talked about transports. I talked about the DAX. Gold also, gold will also tell us if there's a lot of fear in the market. Gold has been a really tough trade as well as bonds have been for the year. I would personally wait until this kind of breaks. It's above the 200-day moving average, but a lot of times it's been fading once it gets to the top of the range. So for gold, I would wait until this gets maybe above 123.30. That'll be a little bit of confirmation that there's definitely some bullish trades that are being sustained and going through. Same thing with FXY. I'm already long FXY. I got long on the break of the 200-day moving average. But if you don't have a position right now and you're thinking about going long the yen, I would wait until it also gets out of this range as well. RSP, I'm not sure if I talked about this one already, but I talked about SPY and IWM. The one flaw that I think people take a look at SPY and they say, hey, it's a little bit biased. Why is SPY biased? Because it's only 500 companies, and it's also the largest company. So it's market cap weighted. Market cap weighted index has your largest companies, such as Apple, is the biggest weight. RSP is an ETF that is when it takes the same 500 names that are in the S&P 500, and instead of market cap weighting them, it takes those 500 names and spreads them out equally. So it's an equally weighted ETF, meaning every name has the exact same weight. When you take a look at this, it's kind of in between small caps and it's kind of between the technicals are between IWM and SPY. It's sitting at the 100-day moving average. So it did break the 50. It's sitting at the 100 right now. So I think if it breaks the 100, I would say watch out, right? That's another sign that there's more volatility in the market and something else is going on, right? There's more weakness out there. VT is another one I think is very interesting to watch. What is VT? It's global equities. So it's everything. And it's good to see how everything is moving together in one chart. So this is global, again, all global equities, and we're sitting right at 50-day moving average support. So right now, most of these things are just indicating a dip. We don't really have much breaking below the 200-day moving average. We go back to the sectors, and you could see like the market breadth. It's definitely a different picture than it was for most of the year. I mean, this is basically what it's looked like all year long. All of 2017, we've had most of the sectors in the S&P have been strong, and I define strong as being above the 50, the 100, and the 200-day moving average. And they've been rotating back and forth, but the majority of them, 7 or 8 of them, have been above the all of the major moving averages. This is one of the first weeks that we've seen it different, right? Now, this is what it currently looks like. We only have 3 sectors above the 50-day moving average. So XLI, XLY, XLV, industrials, consumer discretionary, healthcare, they all broke below the 50-day moving average. So is this game over? I would say no. I would say you want to watch these things very closely. We still only have 2 sectors, which have been basic energy has been underneath the 200-day moving average for most of the year. So that's really not a major problem. It's only 7% of the S&P. It's just not that impactful. And I think people have kind of realized that over this year and said, it is what it is with energy. It's dependent on what oil is doing, and oil is not in a bull market. Telecom, which is the very defensive area of the market, still is below the 100 and the 200-day moving average. And then you've got a couple sectors that are kind of in between here. They're below the 50 and the 100, but they're above the 200. So really, if some of the bigger, riskier sectors start to break below, more of them break below the 100-day moving average, and then if we have any of the riskier sectors break below the 200-day moving average, just like we looked at with transports, the DAX, small caps, then we know we've got it's more problematic than just a dip. But for the time being, that's all we have right now. So rather than speculating if things are really going to break and get out of get out of the uptrend, I say no, there's no reason to really do that until it happens. Let price be the confirmation. Don't let opinions, don't let what's on TV be your indicator. That's the price is king, and if that breaks the 200-day moving average, that is evidence that something is going on here and it's not good. But we really don't have that in many places, and I don't really see anything that's breaking below that is majorly has a big impact in the market. We're close in a lot of things. All right, so that's pretty much the macro review. Again, why do I spend so much time on global things, on currencies, on bonds, gold? Because that's the type of market that we're in right now. I talked about in the beginning about implied correlations, how they perked up a little bit. So for the time being, everything's moving together. So I spend less focus on single name stocks when implied correlations move up, right? You always have to trade the market that you're in, not in the market that you want to be in, right? So if everything is moving all as one and implied correlations are very high, you could just trade indices in that sense, because there's no edge in single stocks, or less edge than there normally is. All right. So that said, let me go over last week's option activity. Option activity, for the most part, was very quiet. When you started the week, we'll go over some of the transactions at the beginning of the week, but it was a completely different picture in the beginning of the week. If you remember, Tuesday we hit 52-week highs in SPY and in Dow, and in a few sectors. I think XLF hit a 52-week high on Tuesday, intraday. This is all intraday. XLK, I believe, also hit a 52-week high on Tuesday. So just a couple days ago. So different kind of picture. One name that I've been in, and I got in, it really didn't do much last week for me, but was Procter and Gamble. And I'm going to go through each chart, and I'm going to go through them in a little bit of a different chart format. I'm going to use the value areas, but Procter and Gamble, it's on the verge of breaking out. It kind of stalled here, so I'm still in a trade, especially Friday when technology kind of came back a little bit. Consumer staples and so forth. Which Procter and Gamble is the biggest weight in the XLP ETF, just really didn't perform too well. So nevertheless, I'm still in this trade. I will be in it for a little while. We've seen a lot of call buying from about a week to 2 weeks ago, and I think it's also good to have some different things in your portfolio right now that have low correlations. So Procter & Gamble is one thing that we really kind of picked up on as repeat call buying in. I would say this name as well was interesting. This name, from when they started buying calls and stay, has dipped. So there's a total of 15,000 of these that went up, I think, on Monday, which I believe that was after they reported. So this is an interesting name. So extended stay. So Monday, so it reported on 7/31, and then they started to buy calls, I think on 8/7. So a lot of the times you can get into things cheaper than when you see them on the tape, especially when you have volatility that's going to bring everything down. So they did come in, I think, a little bit later in the week, and they bought a little bit more. I think the open interest right now on stay is 15,000 right now for the September 20s. So you got a big chunky open interest on here. So maybe a level to watch. It's broken, but I don't really like the the technicals, how far it broke below the value area for the month. But I would say 1909, which I know is a decent amount back up there. But really, that'll tell you if it's not breaking down. So if you want to be a little bit late with this one, you could probably still get in cheaper than they did, even if it gets above this 1909. I still think you can get cheaper into those cheaper, or you could just buy the stock. It's an under $20 price stock, so it's not that expensive just to buy the stock outright. When we move over to Tuesdays, you can see Procter's on here as well. Kind of go through the list here. A lot of different names in here. There wasn't anything that really kind of caught my eye that much. There was a little bit of JCI that went up on Monday. I did not take that trade as well. If we move over to Wednesday, where the volatility started, there was a couple of trades that I highlighted here. Again, I wasn't not really looking for, TJX was interesting, but they report earnings this week, so I'm really not interested in this earnings flow in really short-term trades. But we did see a lot of buying in retail names. Retail calls. A lot of it, I think, is because they all report earnings, and it's not my favorite trade to really take a name. A couple days before they report earnings, because I'm not going to hold it through earnings. There's no way. But we saw a little bit of Burlington calls as well, and a couple other AEO, Taylor. Not names really where I really wanted to set up a lot of risk. Bud, I thought those were interesting. We saw Bud a couple times. This is a name that after earning it jumped on earnings, gapped up on earnings. Well, it filled the whole gap back to the downside. So great numbers, and you got a chance to buy it. It was at 123 bucks. Now it's at 115. So this is another name I went long last week. I think I'm a little bit underwater in it because I think I purchased these on Wednesday. I think I may have added to a little bit on Thursday. LRCCX. My personal stances on the semis is I really want to see some big order flow. Any small order like this, 500 contracts, will go up on my watch list, and then I kind of wait for repeat activity. I think it looks pretty good in terms of technicals. It didn't really break down all that badly. I kind of want to see if names, when everything gets beaten up pretty badly, I want to see if some names kind of hang in there. I view that as strength. So right at the bottom of value. So I'm waiting for, I have an alert out there as well in Lamb Research for it to get above the open from Tuesday. So right above 156 is where I become interested in this name again. And also, of course, if we see more option activity. So moving on to Thursday. Thursday was the name where everything got smoked. LP, and again, you could see that this is really not a lot of option activity on the call side. Wednesday and Thursday, especially Thursday, I put down as many orders in here, but a lot of it is it's pretty small stuff, right? GG is a gold name. 300 contracts of Tesla. It was not a lot of risk taking. Basically how it works when there's a lot of volatility, when you come in the morning and you see that a lot of things are down quite a bit. What I look for is when the buyers step back in. And Thursday morning, we did not see that for the first couple hours. We saw mainly all put buying. So I didn't really do much for the majority of the week. I did not trade a lot. I did not unwind either. Which in hindsight, of course, I would have done maybe a little bit more on Tuesday when I saw that we failed to hold the new 52-week high, really sold off from there. But I basically just kind of stayed the course. Western Digital was another trade that, hey, you've got defined support. Western Digital I think is a tougher name. But if as long as you're disciplined and you give this thing a bounce, or a shot for a bounce, I should say, at the 200-day moving average, if it doesn't work, you know exactly where to get out of it. But you've got that major support, just like you do in IWM and in the transports ETF. So they did come in a couple times for Western Digital, small, little orders like this, 2,000 contracts. Okay, so RTN, a lot of chatter out there about, there was this, this big order in Raytheon, they make the missiles, keep in mind, people don't associate the probability of these trades working out. So if you go to the strike, right, 195, how far is 195 up there, right? It's $15 away, right? So $15 divided by 180, you're talking about an 8% move. Raytheon, it's very rare when Raytheon moves up that much. So this is what I told traders in the trading room when this order went up late Thursday. Said, if you think that we are definitely going to war, or if you think it's a very high probability that we're going to war with North Korea, then this may be an order for you. So this would be something that I would think would go up and maybe have a chance of going up 8%. But Raytheon has been a name that's been grinding higher. it's pretty overbought. It's a 76 RSI. So that's the way I kind of view some of these orders is what would need to happen for this thing to jump up another 8% within a month. And 195, you can't even see it on the screen. It's going to be up here, right? So you need a hockey stick movement. You basically need a war to go on, I think, for this order to work. Now, I could be wrong. That's just my opinion. And if that happens, where you're going to have a whole nother amount of things to play besides going long RTN. You're going to see you may be buying puts in that situation. Everything is probably going to go down if that happens. Who knows? But that's just kind of playing out scenarios that could happen. So that's why I did not take this order, even though it did go up it inched up Thursday, and I think it inched up Friday as well. What was it up Friday? It was up 1%, so it was up $1.73 on Friday, even though it did this. Whoops, I hate that. So even though it sold off, it didn't take out Thursday's highs. So just bear that in mind. All right, so another name, VNDA, that we saw some call buying in late Thursday was VNDA. And then if we get to Friday, what do we see in Friday? I'll tell you what my favorite order is, but let me just go through these chronologically. NCLH, this is a cruise line. We often see the name. This name had a secondary priced out, so somebody took advantage of the dip, which we see this in these cruise lines quite frequently. But someone took advantage of this, and it did rally from the lows. It actually got all the way. I think this is right in here when we saw the calls go up, and it rallied all the way to the bottom of value in NCLH. So again, pretty good signal when we see dip buying in the cruise lines. Again, this one just happened to be right after they had the secondary. SKX, Skechers has been a name where, if you remember this name way back in here, I believe we saw a lot of call buying in here, and this name jumped up. So this name, a lot of people made a lot of money on this name. I think this was a couple months ago. Oops, this is the wrong chart. Sorry, in here. This was a couple months ago. Back in May, June, we saw a lot of call buying, and this thing picked up from 24 bucks to about 29. So it's been kind of hanging out here. It did have earnings, or didn't really. It was kind of a non-factor for earnings. If you remember that earnings day for Skechers, it looked like it was going to get crushed. And then it came all the way back, and you have this crazy doji candle. So it looks like it's trying to break out again, and I like this. So I would say this is my second favorite order on Friday. Out of all the orders that we saw all last week, Skechers is probably my second favorite order, because again, last week was kind of garbage in terms of order flow. But this is why I like it. Besides the call buying, and again, the option activity, basically what it does is it just alerts me to take a look at the name, right? Take a look at the technicals, see how things line up. What's going on in the name? Why is somebody buying it? And then you can kind of go from there. But again, I'm always looking for ideas, and that's half of or three-quarters of what option activity does for me. Does other things for other people, but for me, it kind of just opens my eyes to a name that maybe wasn't on my radar at all. So we look at this thing, SKX, MACD crossover. That's nice, perfect, just fresh MACD crossover. You look at this on the hourly time from when we saw this as well. You had an MACD crossover. You actually saw this on 3 different time frames. Same thing here. I think we saw this in here, MACD crossover. So really kind of set up nicely on multiple time frames. Resistance, I would say 32.11 before it hits anything. So you got good $3 before this hits any major resistance, if it can get above this little hump here. So I did take this trade on Friday. Not a huge trade for me, but I did stay in it. I took a little bit of the risk off on Friday because I really didn't want to put any major risk on going into a weekend, especially in a heightened volatility atmosphere. The other trade that I really liked was Red Hat. Sorry, did I cover all these? I wanted to save Red Hat for the last. Comcast. It is very interesting when we see calls bought and puts sold. So if we look at the Comcast chart, again, no weakness in the Comcast, for last week. It did hit a VPOC last week, which sometimes we see a little bit of a pause after that. So I did not take this one, Comcast, but we saw calls being bought and puts being sold. So now we'll get to Red Hat. Really nice looking candle on Friday. Weakness with a lot of tech. We kind of came in and made a high back on 727, and it's been slipping, making a little bit of lower highs, lower lows. But on Friday, we took out a couple candles. We took out the Wednesday candle, and we took out the Thursday candle. Defined support for really disciplined support would be 97.31. Below that would be the 50-day moving average. So I did take this trade as well. Again, I was like, you kind of make up your mind, on a Friday, and you're like, I'm not adding any more risk unless I see something really interesting. So Red Hat, those were September 100 calls. They were pretty sneaky about it too. There was a lot of accumulating under 500 contracts. There was no big print of like 3,000 contracts. There was a lot of small accumulation in Red Hat. And then last one was X-Ray. So if you're looking for one that's, gotten really beaten up after earnings, with an RSI, for a counter trend trade, you got an RSI of 17. So really, really oversold. You got a hammer bar down here. Again, it's below the 200-day moving average. The thing got crushed on earnings. So, maybe somebody's thinking, hey, this thing got beaten up a little bit too badly. RSI, the relative strength index indicator, is really good for seeing if something has gotten just annihilated a little bit too far. Again, a 17 RSI is pretty oversold. Granted, things can get more oversold. Take a look at a name like Teva. Teva is sitting around an 11 RSI. So I know a bunch of people are kind of thinking that this is due for a little bit of a bounce. So we'll see. I would also keep an eye on this name, Teva, if you're that type of a trader or counter trend trader. I do not do very many counter trend trades. I'm more of a trend trader, but still, I like to point these things out because some people love to play names that they think have gotten too far away from the mean. So that is it. That is it for the quick option review. I know this is a long video, so there's a lot of things to talk about. Again, I think you really want to look at as many different things right now and see to kind of tell you if something really bad is going on, or if we just have a regular dip going on. So for me, I think this is another dip to buy. Where I would say, no, this is not looking like a regular dip to buy, is if things really start breaking below. So I've already mentioned this several times on this call, but I think the small caps, I think the DAX, the German index, and transports are also, so you've got three things there. And then also watch the VIX. If the VIX really starts to back off, as I mentioned, there was a lot of profit taking on Friday, but that doesn't mean that they're going to be right. If the VIX starts to really back off and kind of settle in, maybe around an 11 or maybe 11 to 13 range, that says something versus the VIX taking another leg up and going up to about a 20. So those are the things that I would be very, very cognizant of, and keep on one screen. All right, everybody, enjoy the rest of your weekend, and good luck trading in the beginning of the week. I will also do another video Monday morning for the value areas and how they're setting up for the indices, so stay tuned for that. Thanks, everybody. Have a great night.